Imagine sending $100 across the world late on a Sunday night. The person receiving it may be thousands of miles away, perhaps in a country where access to the United States banking system is limited, where international wires are expensive, or where the local currency has been losing value for years. In the traditional financial system, the payment may pass through several institutions before it reaches its destination. There may be bank operating hours, compliance checks, foreign exchange conversions, correspondent relationships, fees, and a delay between the moment one person believes the money has been sent and the moment another can actually use it. Yet, on a blockchain, a very different transaction can take place. A digital token representing one United States dollar can move from one wallet to another without the physical dollar moving at all. The token may cross national borders while banks are closed. It can be transferred by software, held in a digital wallet, traded on an exchange, sent to a merchant, or placed inside a financial application built entirely on blockchain infrastructure. It looks like cryptocurrency. It travels like cryptocurrency. But it is not supposed to behave like Bitcoin. Its purpose is not to double in price, collapse by half, or become an object of speculation. Its promise is almost the opposite. One token is supposed to remain worth approximately $1. This is the idea behind the stablecoin, one of the strangest and potentially most consequential developments in the long history of money. The name sounds modest. Stablecoin, a coin that does not move very much. But behind that simple description lies a larger question about the architecture of modern finance. If dollars can move across open digital networks in the form of tokens, what happens to banks, payment companies, credit card networks, money transfer businesses, central banks, regulators, and national currencies? If millions of people outside the United States can hold dollar-linked tokens without opening an American bank account, does that weaken the dollar or extend its power? If businesses can settle payments through blockchain networks at any hour, does banking become less important, or do banks simply reinvent themselves again? And if everyone holding a stablecoin suddenly asks for real dollars at the same time, who provides the money? These are not merely questions about cryptocurrency. They are questions about trust, because every form of money, from the earliest metal coins to the balance displayed on a banking app, has ultimately depended on people believing that what they hold will still be accepted tomorrow. To understand why stablecoins matter, it helps to begin long before computers, blockchains, or digital wallets existed. Human beings have spent thousands of years searching for ways to make value portable. Barter could work in small communities, but it required coincidence. A farmer with grain who needed a tool had to find someone who wanted grain and had a tool to exchange. Commodity money improved the problem by giving societies widely recognized objects that could serve as stores of value and means of exchange. Salt, cattle, shells, precious metals, and other goods performed this role in different places and periods. Metals became particularly useful because they were durable, divisible, portable, and difficult to reproduce cheaply. Coinage standardized weight and authority. A stamped coin did more than contain metal. It carried information. The mark of a ruler or state told the holder that someone powerful had certified its weight and purity. Money was already becoming a technology of trust. Over time, carrying large quantities of metal became inconvenient and dangerous. A merchant traveling with gold faced theft, transport costs, and the simple burden of weight. Banking practices evolved to separate ownership of value from physical possession. Instead of carrying metal, a person could hold a claim on metal stored somewhere else. Paper money pushed that separation further. A banknote had little intrinsic value compared with the gold or silver it might represent, yet it could circulate because people trusted the issuer and expected others to accept it. The history of money became a history of abstraction. A valuable object became a claim on a valuable object. A claim became a paper note. A note became a deposit recorded in a ledger. A ledger entry eventually became digits inside a computer. By the late 20th century, enormous amounts of money already existed in forms that no person could physically touch. Salaries arrived as electronic deposits. Bills were paid by instruction. Credit cards allowed consumers to initiate transactions without exchanging banknotes. Automated teller machines gave access to cash from computerized records. Electronic markets moved securities through databases. The internet made those databases accessible from homes and mobile phones. By the time the smartphone became an ordinary part of life, a person could receive wages, pay rent, buy groceries, invest in stocks, and send money to a friend without touching a single coin. In that sense, digital money was not invented by cryptocurrency. Modern banking had been digital for decades. What cryptocurrency changed was the location and structure of the ledger. A bank account exists because a bank maintains a record of what its customer owns and owes. A card payment works because a chain of trusted institutions agrees to update their private ledgers. A blockchain offered another idea, a shared digital record maintained according to network rules, where transferable assets could move without depending on one bank's internal database. That idea emerged most famously with Bitcoin. Introduced during the aftermath of the global financial crisis, Bitcoin proposed a digital asset that could be transferred peer-to-peer according to a predetermined protocol. It had no central bank controlling its supply and no commercial bank promising redemption. Its scarcity was created by software rules. For supporters, this was revolutionary, yet the same features that made Bitcoin interesting as an alternative asset made it difficult to use as ordinary money. The price could move dramatically. A worker does not want a monthly salary that might lose a large portion of its purchasing power before rent is due. A shopkeeper does not want to price bread in a unit whose value can swing sharply in hours. A business does not want to sign a contract for future payment if the settlement asset might be worth far more or far less by the time the invoice is paid. Even inside the cryptocurrency economy, volatility created a practical problem. Traders wanted to move out of risky assets without necessarily leaving blockchain markets. Exchanges needed a convenient unit of account. Developers wanted an asset that behaved more like cash while remaining compatible with digital networks. The crypto economy had created new financial rails, but it lacked a dependable dollar traveling on those rails. Stablecoins emerged as an answer. Early experiments explored several designs, but the basic ambition was easy to understand. Combine the transferability of cryptocurrency with the familiar stability of government money. Tether, launched in 2014, became an early and eventually dominant example of a dollar-linked token designed to facilitate the digital use of traditional currency. USDC followed in 2018, launched by Circle and Coinbase through the Center Consortium, with an emphasis on dollar backing, transparency, and integration into a growing ecosystem of exchanges and applications. What began primarily as infrastructure for cryptocurrency trading gradually became something larger. Stablecoins made it possible to hold and transfer dollar-denominated value inside blockchain networks. That distinction matters. Bitcoin tries to be a monetary asset whose value is determined by the market. A dollar stablecoin tries to represent a claim or instrument that remains close to $1. The goal is not appreciation. The goal is stability. But the moment that promise is made, another question appears. Why should anyone believe the token is worth $1? A label cannot create value. Software cannot simply declare that a token is equal to government currency and make the claim true. The answer lies in the mechanism behind the stablecoin. In the simplest reserve-backed model, a customer or authorized participant provides dollars to an issuer. The issuer creates or mints an equivalent amount of tokens. Those tokens can then circulate on supported blockchain networks. If they are eventually returned for redemption under the issuer's terms, the issuer provides dollars and destroys or burns the redeemed tokens. In theory, the cycle is straightforward. Money enters, tokens are created, tokens circulate, tokens return, money leaves, and tokens disappear. The critical institution is therefore not merely the blockchain. It is the reserve. If $1 billion linked tokens are in circulation, holders need confidence that the issuer possesses enough high-quality assets to satisfy redemption obligations. Those reserves may include cash, deposits at financial institutions, short-term government securities, or other permitted liquid assets depending on the issuer and regulatory framework. The composition matters because a reserve can appear safe during ordinary conditions, but behave very differently during panic. Cash is immediately usable, but holding large amounts of idle cash can be costly. Short-term government securities may be highly liquid, but they still need to be sold or matured before they become cash. Bank deposits provide access to payment systems, yet they create exposure to the banks holding those deposits. Every reserve structure, therefore, contains choices about liquidity, yield, counterparty risk, and operational resilience. This is why a stablecoin can look like a technological product, while behaving economically like a financial institution. The token may live on a blockchain, but its credibility can depend on custodians, banks, asset managers, auditors, lawyers, regulators, and the market for government debt. A user sending a token may see only a wallet address and a confirmation. Hidden beneath that simple transaction is a chain of institutions connecting digital code to national money. Not every stablecoin uses the same model. Some are backed by traditional financial assets. Others are collateralized by cryptocurrencies, often requiring more collateral than the value of tokens issued because the collateral itself can fluctuate. Still, others have attempted algorithmic designs in which economic incentives, linked tokens, or automatic market mechanisms are supposed to maintain the target price. These models should not be treated as equivalent. A token backed by liquid dollar assets presents different risks from one backed by volatile crypto collateral, and both differ from a system that depends primarily on market incentives to preserve a peg. The word stablecoin describes an objective, not a guarantee. This distinction would become painfully clear as the market expanded. Yet before examining failure, it is important to understand why people wanted these instruments in the first place. The first major use was straightforward: trading. Cryptocurrency markets operate continuously. Bitcoin does not close at 4 in the afternoon. Blockchain networks do not take weekends off. Traders wanted a dollar-like asset that could move through the same environment. Stablecoins became a bridge between volatile crypto assets and the unit of account most participants already understood. A trader could sell one digital asset for a stablecoin, remain inside the crypto ecosystem, and later buy another asset without necessarily returning funds to a conventional bank. This made stablecoins deeply useful to exchanges and decentralized finance applications. But once a transferable digital dollar existed, other possibilities followed. Businesses could use it for settlement. Individuals could move it between platforms. Developers could incorporate it into software. Merchants could receive it. People in countries with unreliable currencies could use it as a way to hold dollar-denominated value. International payments could potentially move through new routes. These use cases turned stablecoins from a crypto market convenience into a monetary experiment with implications far beyond crypto speculation. Consider the problem of cross-border payments. The modern financial system is global, but the infrastructure beneath it was built from national systems connected through layers of intermediaries. When a company in one country pays a supplier in another, the transaction may involve the sending bank, a correspondent bank, another intermediary, a receiving bank, a foreign exchange provider, and various compliance systems. Each institution performs useful functions. They screen transactions, manage liquidity, convert currencies, prevent fraud, and comply with national law. But the result can be slow and expensive, especially for smaller payments or transfers involving less well-connected countries. A blockchain-based stablecoin can potentially simplify part of that route. Instead of instructing several private ledgers to reconcile sequentially, the token can move on a shared network. The transaction may be technically final according to the blockchain long before conventional settlement would have occurred. Software can operate 24 hours a day. A business does not have to wait for one national banking system to open before another closes. For users accustomed to instantaneous messaging, this seems almost obvious. Information became global and continuous decades ago. Why should money still behave as though the world operates only during banking hours? Yet the comparison can be misleading if it suggests stablecoin payments are magically free or independent of institutions. Someone still has to acquire the token. Someone may need to convert it back into local currency. Wallet providers, exchanges, banks, blockchain validators, and compliance services may still be involved. Network fees can rise. Users can make irreversible mistakes. Governments can impose restrictions. Fraud does not disappear because the settlement rail changes. The stablecoin may reduce certain frictions while creating new ones. It is better understood not as a complete replacement for the financial system, but as a new layer that can connect to it in different ways. That new layer becomes especially powerful, where people want dollars, but cannot easily obtain dollar bank accounts. In a country experiencing high inflation or repeated currency depreciation, a local resident may see the dollar not as a foreign curiosity, but as protection. Traditionally, accessing dollars might require physical cash, a foreign bank account, informal markets, or expensive financial services. A dollar stablecoin creates another route. Anyone with compatible technology and legal access may be able to hold a dollar-linked digital asset in a wallet. The individual does not necessarily own a claim identical to a bank deposit and may not receive the same protections, but economically, the stablecoin can still function as a form of digital dollar exposure. This is where the stablecoin story moves from convenience to geopolitics. A technology originally developed inside cryptocurrency markets can become a vehicle for dollarization. A citizen in another country may never touch an American banknote, yet still choose to save in a token linked to the United States currency. If that behavior becomes widespread, weaker national currencies could face new competition. Central banks could find it more difficult to control domestic monetary conditions. Governments may respond with regulation, restrictions, or their own digital systems. Stablecoins can therefore increase individual access to a globally desired currency while simultaneously raising questions about national sovereignty. The same tension appears inside the banking system. To most depositors, a bank account looks like money waiting to be used. But from the bank's perspective, deposits are also funding. Banks combine deposits with other sources of financing and use their balance sheets to make loans, buy securities, provide credit lines, and support the payment system. If a customer moves $10,000 from a bank deposit into a stablecoin, the customer may feel as though money is simply moved from one container to another. Yet the banking system may experience a change in funding. If millions of customers do the same thing, the effect could become meaningful. Banks might need to replace lost deposits with wholesale funding or other sources that could be more expensive or less stable. Lending conditions might change. Competition for deposits could intensify. The structure of financial intermediation could shift. This possibility is one reason policymakers and bank economists have paid growing attention to stablecoins. The concern is not that a token suddenly destroys banking. It is that the allocation of money across balance sheets may change. The effect also depends on what stablecoin issuers do with their reserves. If reserve funds ultimately return to commercial banks as deposits, some money may remain within the banking system, though distributed differently. If reserves are invested heavily in short-term government securities instead, funds may move away from bank deposits and toward treasury markets. In that case, stablecoin growth could alter both bank funding and demand for government debt. The exact result would depend on regulations, reserve practices, user behavior, and how banks respond. History suggests banks rarely stand still when threatened by new financial technology. They adapt. They lobby for new rules. They create competing products. They purchase rivals. They lower prices in some areas and invent fees in others. They incorporate technology that once appeared to threaten them. The rise of money market funds, credit cards, electronic trading, online banking, and fintech companies all force changes without eliminating banks. Stablecoins may produce a similar pattern. Banks can develop tokenized deposits, provide custody, connect customers to blockchain networks, hold reserves for issuers, or build settlement services of their own. In this sense, the stablecoin revolution may not be a war between old banks and new tokens. It may be a struggle over which institutions control the next generation of payment rails. A crucial distinction begins to emerge. Banking performs several functions that are often bundled together. Banks store deposits, facilitate payments, evaluate borrowers, create credit, manage maturity transformation, provide financial advice, and connect customers to markets. Stablecoins may compete strongly with certain payment and settlement functions without replacing the entire bundle. A token can move value, but it does not automatically evaluate whether a family should receive a mortgage or whether a factory can repay a 10-year loan. If stablecoins reduce banks' role in payments while banks remain central to credit, the architecture of finance could become more modular. Payments might separate from lending in ways that are difficult to imagine when both services occur inside the same banking relationship. This possibility leads to one of the deepest questions in the story. What if the revolution is not about replacing banks, but about separating banking from money movement? For centuries, the institutions that stored money also controlled many of the routes through which it traveled. A programmable token on a public or permissioned blockchain challenges that arrangement. The token can move according to software rules outside a bank's private ledger, yet it may still rely on banks to connect the digital system to government currency. The old institutions and new infrastructure become competitors and partners at the same time. Now consider what happens when that infrastructure scales across borders. A multinational company manages money in many currencies, time zones, and legal systems. Treasury teams must decide where cash sits, how quickly it can be moved, and what happens when markets close. Stablecoins potentially allow certain forms of corporate liquidity to travel continuously. A supplier can be paid after banking hours. Funds can move between affiliated entities. Smart contracts can automate payments when predetermined conditions are met. Financial applications can treat money as programmable data. The attraction is obvious, but so is the risk. Code can execute quickly in both directions. A payment can settle rapidly, but so can a mistake. Liquidity can move efficiently, but so can panic. A financial system built for speed may discover that speed amplifies human fear as effectively as it amplifies convenience. Before confronting that danger, however, there is another consequence that would have seemed paradoxical during cryptocurrency's earliest years. Stablecoins may strengthen the international role of the United States dollar. Cryptocurrency was often presented as an escape from government money. Bitcoin supporters spoke about monetary independence. Blockchain advocates imagined borderless alternatives to the banking system. Yet the largest stablecoins are overwhelmingly denominated in dollars. The market's most successful attempt to create stable digital money did not reject fiat currency. It copied the currency users already trusted most. The result is a digital dollar ecosystem that can extend beyond the geographic boundaries of the United States. A person can use a dollar-linked token on a blockchain without using a physical dollar and, in some cases, without maintaining a conventional dollar bank account. Rather than replacing the dollar, blockchain technology can become another distribution network for it. This is one of the great ironies of the stablecoin revolution. A movement born partly from skepticism toward centralized finance may help export the monetary unit issued by the world's most powerful central bank. By 2026, the Bank for International Settlements estimated that roughly 98% of stablecoin value was denominated in dollars. That concentration matters because currencies derive international power partly from network effects. Businesses invoice in the currency others accept. Investors hold assets denominated in the currency others trust. Banks maintain liquidity in the currency their counterparties use. Governments borrow in markets where demand already exists. Each additional user can make the network more useful to everyone else. If stablecoins introduce millions of new users to dollar-denominated assets, they may reinforce those network effects. Reserve management strengthens the connection. Large reserve-backed stablecoins may hold significant amounts of short-term United States government debt. As circulation grows, issuers may become larger buyers of treasury bills. A digital token circulating on a blockchain can therefore be linked directly to the traditional market that finances the United States government. The futuristic interface hides an old financial instrument underneath. A user in one country holds a token. The issuer holds reserve assets. Those reserves may include treasury securities. The United States government issues those securities to finance its operations. A chain that begins with a digital wallet can end at the heart of sovereign debt markets. This does not mean stablecoins automatically guarantee dollar dominance. Other countries may support digital versions of their own currencies. Governments may restrict foreign stablecoins. Users may migrate to different assets. Political changes can reshape trust in the dollar itself. But the early pattern shows that technological change does not necessarily overturn monetary hierarchy. Sometimes new technology strengthens the incumbent. The internet did not make every language equally dominant. Global networks often amplify standards that already possess scale. Stablecoins may do the same for money. Yet the larger they become, the more dangerous a failure could be. The central promise of a dollar stablecoin is simple. One token should remain worth $1, but stability is a promise, not a physical law. The history of a finance is filled with instruments that appeared perfectly safe until people tried to exit at the same time. Bank deposits can be stable for years and then disappear in a run if confidence collapses. Money market funds can appear cash-like until the value or liquidity of their assets comes into question. Fixed exchange rates can survive for decades and then break when markets stop believing governments can defend them. Stablecoins inherit the same logic. Their technology may be new, but the psychology is ancient. Imagine an issuer with billions of tokens outstanding. Under normal conditions, only a small fraction of holders redeem on any given day. The issuer keeps enough liquidity to satisfy ordinary demand while investing reserves in safe assets. Then a rumor spreads. Perhaps a custodian has failed. Perhaps a reserve report is questioned. Perhaps regulators have opened an investigation. Perhaps the price slips below $1 on a major exchange. At first, some traders see an opportunity. If the token can still be redeemed for $1, buying it at 99 cents offers a profit. Their purchases can help restore the peg. But if doubt intensifies, arbitrage can reverse into a race. Holders no longer ask whether the token will recover next week. They ask whether they can redeem before everyone else. Selling pressure pushes the market price lower. Social media spreads screenshots in seconds. Automated trading systems react immediately. Blockchain data makes large movements visible. Redemption requests surge. The issuer needs cash. If reserves are genuinely liquid and accessible, the system may absorb the shock. But if assets cannot be sold quickly, if a custodian is unavailable, or if redemptions are operationally restricted, fear can become self-reinforcing. People redeem because they fear others will redeem, and their redemptions create the very stress they feared. This is the mechanics of a run. Stablecoins do not abolish it. They may compress it into digital time. The failure of Terra USD in 2022 showed why the word stablecoin must never be treated as proof of safety. Terra USD, usually called UST, was built around an algorithmic mechanism tied to another crypto asset, Luna, rather than the conventional model of a reserve filled with dollars and short-term government securities. Its design sought to preserve the $1 relationship through market incentives and the ability to exchange UST and Luna according to protocol rules. For a time, the system became enormous. High advertised yields attracted users, confidence drew in more capital, and growth itself seemed to validate the mechanism. But a monetary arrangement that depends on confidence can look strongest just before that confidence disappears. In May 2022, UST lost its peg. The mechanisms that were supposed to restore stability were overwhelmed. As holders fled, pressure on the linked Luna token increased. The feedback loop accelerated. The value of both collapsed, destroying tens of billions of dollars in market value and damaging confidence throughout the digital asset industry. The episode was not evidence that every stablecoin was built the same way. In fact, it demonstrated the opposite. It forced investors, regulators, and ordinary users to distinguish between different forms of stability. A reserve-backed token, a crypto-collateralized token, and an algorithmic token may all carry the same label. But the economic foundations beneath them can be radically different. Terra USD also exposed a broader truth. Financial engineering cannot manufacture trust indefinitely if people begin to doubt the assets, incentives, or institutions supporting a promise. When confidence collapses, elegant mechanisms can fail at the speed of the market. Less than a year later, another event revealed a different kind of vulnerability. In March 2023, Silicon Valley Bank failed after a rapid deposit run. The bank was part of traditional finance, not a blockchain protocol, yet its collapse reached directly into the stablecoin market because Circle held a portion of the reserves supporting USDC at the bank. Circle disclosed that about $3 billion of USDC reserves were caught at Silicon Valley Bank when regulators took control. USDC, which was designed to remain at $1, fell below its peg in secondary markets as traders questioned whether all reserve assets would be recoverable. The event became a remarkable demonstration of financial interconnectedness. A stablecoin had been created partly to make dollars move on blockchain networks, but its stability still depended on ordinary bank deposits. A bank run in California traveled into 24-hour crypto markets, and fear in crypto markets reflected back onto expectations about the banking system. USDC later returned toward its peg after authorities announced measures related to Silicon Valley bank depositors, but the episode left an important lesson. A reserve can be composed of conventional assets and still face conventional risks. The blockchain had not failed. The smart contract had not necessarily failed. The vulnerable point was the bridge between digital money and traditional finance. This is why stablecoin regulation increasingly focuses less on the novelty of tokens and more on questions that would be familiar to any bank supervisor. What assets back the liability? Where are those assets held? How quickly can they be converted into cash? Who has a legal claim on them? What happens in bankruptcy? Who can redeem directly? How transparent is the reserve? What happens if a custodian fails? How is money laundering prevented? How are customers identified? How is operational risk managed? The stablecoin revolution becomes less mysterious when viewed through these questions. The technology may be 21st century, but the problems are centuries old. Governments eventually had to decide whether stablecoins would remain largely outside the traditional regulatory perimeter or be incorporated into it. The United States spent years debating the issue. Different agencies argued over jurisdiction. Congress considered multiple proposals, and the industry grew while the legal framework remained fragmented. Then, in July 2025, the Genius Act established a federal regulatory framework for payment stablecoins in the United States. The significance of the law was larger than the technical details of any one provision. For the first time, the United States had a dedicated federal structure defining authorized payment stablecoin issuers and setting rules intended to support one-to-one value relative to the dollar. Stablecoins were no longer simply a phenomenon that regulators watched from the edge of the financial system. They were becoming an activity for which lawmakers were constructing a permanent legal home. The framework did not end debate. It changed the debate. The question was no longer only whether stablecoins should exist. It became what kind of stablecoin should be allowed to operate at scale, what assets should support it, what disclosures should be required, which institutions should issue it, and how regulators should respond if an issuer becomes systemically important. By 2026, United States agencies were still developing implementation details, including proposals around customer identification. Regulation was becoming part of the infrastructure, not an external reaction to it. Europe had moved earlier with a different model. The European Union's Markets and Crypto Assets Regulation, known as MiCA, created harmonized rules for crypto assets, including categories relevant to stablecoins, such as asset reference tokens and e-money tokens. Its stablecoin provisions began applying in 2024, and the broader framework entered full application at the end of that year. By 2026, European authorities were already reviewing how the framework functioned in practice. The contrast between jurisdictions revealed another layer of the global competition. Stablecoins may travel on borderless networks, but issuers remain subject to national and regional law. A token can cross a blockchain in seconds, while its legal status changes the moment it enters another jurisdiction. The future of digital money will therefore be shaped by an unusual combination of open technical networks and fragmented political authority. Regulators face a difficult balance. If rules are too weak, poorly backed tokens could grow large enough to threaten consumers and markets. If rules are too restrictive, legitimate innovation may migrate elsewhere or never develop. Stablecoins become most useful when people trust them, yet the controls required to create trust can make them resemble the financial institutions they were once supposed to bypass. Reserve requirements, licensing, audits, redemption standards, sanctions compliance, customer identification, and capital rules can all improve safety. They can also introduce cost, centralization, and barriers to entry. The tension is unavoidable because money is not an ordinary software product. A failed social media application is inconvenient. A failed payment system can stop salaries, commerce, and savings. A failed form of money can destroy livelihoods. Governments therefore care about monetary reliability in a way they do not care about most consumer technology. This helps explain why the future of stablecoins cannot be separated from central banks. A central bank sits at the foundation of a national monetary system. Commercial bank deposits are denominated in the unit established by the state. Payment systems ultimately depend on settlement assets and institutions linked to central bank money. Stablecoins borrow their unit of account from this structure. A dollar stablecoin is useful largely because people already know what a dollar means. Its issuer does not create the dollar's monetary credibility from nothing. It imports that credibility. This is one reason officials at the Bank for International Settlements have argued that stablecoins depend on the stability provided by sovereign currencies and central banks, even when they travel on decentralized networks. The observation reveals another paradox. Stablecoins may challenge banks while depending on the central bank's currency. They may reduce reliance on traditional payment rails while holding reserves in traditional government debt. They may be issued by private companies while drawing value from public monetary institutions. They are neither fully outside the existing financial system nor fully inside it. They occupy the bridge. That bridge is becoming crowded because stablecoins are not the only technology competing to define the future of money. Commercial banks are exploring tokenized deposits, where claims on bank deposits can move on programmable ledgers without becoming independent stablecoins. Central banks have studied or developed central bank digital currencies, which would represent public money in digital form rather than private tokens backed by public money. Conventional payment systems are also improving. Real-time payment networks can transfer bank money rapidly without blockchains. Financial institutions are adopting application programming interfaces, cloud infrastructure, tokenized securities, and automated settlement. The contest is therefore not between stablecoins and a banking system frozen in the 20th century. It is between several technologies trying to solve overlapping problems. Stablecoins offer openness, programmability, and the possibility of global distribution. Tokenized deposits offer continuity with the existing banking model. Central bank digital currencies could provide direct digital public money under state control. Faster payment networks preserve familiar legal structures while reducing delay. Each system carries different trade-offs involving privacy, control, credit creation resilience, compliance, and interoperability. There may never be one winner. The future could be layered. Consumers might use bank deposits for salaries and mortgages, stablecoins for certain international payments, tokenized deposits for institutional settlement, and central bank money beneath all of them as the final anchor of value. The important transformation may be not the replacement of one form of money by another, but the fragmentation of functions that once appeared inseparable. This is where the term internet-native money becomes useful. When the internet transformed communication, it did not eliminate newspapers, telephones, television, or postal systems overnight. It changed the cost, speed, and structure of distributing information. Entire industries were reorganized around that new capability. Stablecoins propose a similar shift for a particular form of value. A dollar in a bank account is already digital, but it lives inside a system of controlled ledgers. A stablecoin can be represented as a token that software can transfer and applications can incorporate directly. Money becomes an object that programmers can use in ways similar to other internet resources. A smart contract can release payment when conditions are satisfied. A digital marketplace can settle transactions automatically. A company can move treasury assets between blockchain environments. Financial assets can exchange against tokenized cash without waiting for separate legacy settlement systems. These possibilities sound technical, but the economic principle is simple. When the cost of moving and coordinating value falls, new forms of commerce can emerge. Yet programmability raises questions that are rarely discussed in promotional visions. Who controls the smart contract? Can a token be frozen? Can an issuer block an address? Can governments compel restrictions? What happens when code contains an error? Who reverses a fraudulent transfer? Traditional banking systems are sometimes slow because they contain layers of review and legal recourse. Removing friction can also remove safeguards. The ideal payment is not always the fastest possible payment. It is the fastest payment compatible with trust, security, and the ability to resolve mistakes. A system designed only for speed may discover that human commerce requires judgment. Stablecoins therefore force society to reconsider what people actually want from money. People want money to move quickly, but they also want it returned when stolen. They want privacy, but governments want to prevent terrorism financing and money laundering. They want independence from banks, but they want reliable redemption into bank money. They want innovation, but they want someone accountable when the system fails. These demands pull in opposite directions. The design of future digital money will be a political compromise as much as a technological achievement. One of the most important economic questions concerns what happens to credit if stablecoins grow dramatically. Modern commercial banks do not merely transfer existing money. Through lending, they play a central role in credit creation. A household deposits money in a bank, but the bank does not place every dollar in a vault forever. Subject to regulatory requirements and liquidity management, banks use funding to support loans and investments. A stablecoin issuer operating under a narrow reserve model may behave differently. If the issuer holds reserves largely in cash and short-term government securities, the funds supporting stablecoins may not directly finance private sector loans in the same way ordinary bank balance sheets do. Large-scale migration from deposits into stablecoins could therefore change the path through which savings reach borrowers. Perhaps banks would replace those deposits with other funding. Perhaps lending rates would rise. Perhaps new non-bank lenders would expand. Perhaps the Treasury market would absorb more money as stablecoin reserves grew. The outcome would depend on scale and adaptation, but the possibility illustrates why stablecoins are not merely a payment story. The structure of money affects the structure of credit, and credit shapes the real economy. A mortgage, a factory, a small business loan, and a credit card all depend on institutions willing to transform funding into longer-term risk. If digital money changes funding, it can ultimately change who receives credit and at what price. This is why some emerging market policymakers worry about stablecoinization. If households and businesses increasingly price goods, save, and transact in foreign digital currency, a central bank can lose influence over domestic financial conditions. Monetary policy works partly because the central bank affects the currency in which local debts and prices are denominated. If economic activity shifts toward a foreign unit, domestic policy becomes less powerful. Traditional dollarization already produces this problem. Stablecoins can make dollarization easier by removing the need to obtain physical notes. A phone can become a doorway into a parallel currency system. For an individual protecting savings, that can be rational. For a government trying to manage a national economy, it can be destabilizing. The same technology can be liberating at the household level and threatening at the state level. There is no single political interpretation because the benefits and costs fall on different actors. By early 2026, stablecoin assets had grown into the hundreds of billions of dollars, with the market still concentrated among the largest issuers. This was substantial enough to attract attention from central banks, financial regulators, banks, asset managers, technology companies, and governments, yet still small compared with the enormous scale of global bank deposits, bond markets, and conventional payment systems. That perspective matters. Stablecoins are neither a tiny experiment that can be ignored, nor a force that has already replaced global money. They exist in the middle stage of financial development, large enough to matter, but young enough for their final role to remain uncertain. Predictions at this stage are dangerous. The history of technology is full of systems that grew rapidly and vanished, as well as systems that appeared niche before becoming infrastructure. The challenge is to distinguish temporary speculation from durable utility. Stablecoins have already demonstrated durable utility inside crypto markets. The unresolved question is whether they can move far beyond that origin. Cross-border business payments are one candidate. Remittances are another. Tokenized securities may create a third because markets trading blockchain-based bonds, funds, or other assets need reliable tokenized cash for settlement. Corporate treasury operations may create another. Digital commerce between software agents could create use cases that barely exist today. But every expansion brings stablecoins closer to the parts of finance where governments demand stronger guarantees. Success creates regulation because success increases consequences. A token used by a few thousand traders can fail without threatening an economy. A token used for salaries, trade invoices, and household savings becomes critical infrastructure. At that point, society will demand standards for resilience, redemption, governance, and consumer protection. Stablecoins may become safer precisely by becoming more like regulated money, and in doing so may surrender some of the freedom that made them attractive in the first place. This is not unusual. Financial innovation often begins at the edge, grows quickly because it escapes old constraints, and then becomes integrated into the system once its importance can no longer be ignored. The history of banking itself follows this pattern repeatedly. Private notes, clearinghouses, money market instruments, electronic transfers, and derivatives all forced governments to adapt rules after markets evolved. Stablecoins are another chapter in that long negotiation between innovation and public authority. Their novelty lies in the speed and global reach of the technology, but the political process around them is familiar. The state tolerates experimentation until private money becomes important enough to affect public money. Then the boundary is redrawn. The central question is what that redrawn boundary will look like. One future imagines a heavily regulated stablecoin industry dominated by a few licensed issuers, each holding conservative reserves and connecting deeply with banks. In this world, stablecoins become an extension of the existing dollar system, useful for blockchain settlement and international payments, but far from the libertarian vision of money outside government control. Another future imagines banks themselves becoming the dominant token issuers through tokenized deposits, reducing the space for independent stablecoin companies. A third imagines central banks providing digital settlement assets that private firms build upon. A fourth imagines multiple systems coexisting, connected by bridges that allow users to move seamlessly among bank deposits, stablecoins, tokenized securities, and central bank money. The technology may eventually become invisible. Consumers rarely think about the clearing systems behind a card payment. Future users may not know or care whether an application settles with a stablecoin or tokenized deposit. They will care that the payment is fast, cheap, safe, and reversible when appropriate. If stablecoins succeed completely, the word stablecoin itself may become less important than the infrastructure it helped create. There is a historical pattern here. Revolutionary technologies often disappear into ordinary life. Few people describe an online purchase as a packet-switched communication event, even though internet protocols make it possible. Few people think about database replication when withdrawing cash from an ATM. The most important technologies become boring because they become dependable. Stablecoins have not reached that stage. Their volatility episodes, regulatory debates, reserve questions, and political controversies remain visible, but the direction of travel suggests that the lasting contribution may be conceptual. They proved that familiar fiat units can circulate as programmable tokens on shared digital networks. Even if today's issuers are eventually replaced, that idea is unlikely to disappear. Return now to the $100 sent across the world at the beginning of this story. At first, the transaction looked almost magical. One person pressed a button, another person received digital dollars. The blockchain appeared to have removed the financial system between them, but after following the history, the mechanism looks very different. Behind the token stands a monetary unit created by a sovereign state. Behind the promise of $1 may stand reserves held in banks or government securities. Behind the wallet may stand software written by private developers. Behind the transfer may stand a blockchain secured by validators or other network participants. Behind access to the system may stand exchanges, payment firms, identity checks, sanctions rules, and regulators. Behind redemption may stand authorized institutions and legal contracts. Behind the value of the reserve stands confidence in the United States government, its financial markets, and its central bank. The stablecoin did not eliminate institutions. It rearranged them. This is perhaps the most important conclusion of the entire revolution. Technology rarely destroys trust. It changes where trust is placed. Metal coins place trust in weight, purity, and the authority stamping them. Banknotes place trust in issuers and redemption. Commercial bank deposits place trust in banks, regulation, deposit insurance, and central banks. Stablecoins distribute trust across software, issuers, reserve assets, custodians, blockchains, and law. Their promise is not a world without intermediaries. It is a world with different intermediaries operating through different rails. Whether that arrangement is better depends on what problem is being solved. For a trader moving between digital assets, stablecoins already solved a major problem. For a migrant sending money home, they may reduce cost in some corridors but still require difficult conversion at the destination. For a household escaping inflation, they may provide access to dollar value while introducing custody and regulatory risks. For a bank, they may be a competitor, partner, or a source of reserve deposits. For the United States, they may extend the dollar's international reach. For another central bank, they may threaten monetary sovereignty. For regulators, they combine the familiar danger of runs with the unfamiliar speed of blockchain markets. For software developers, they are programmable building blocks. The same token means something different to each participant because money sits at the intersection of technology, economics, politics, and human behavior. This is why the stablecoin debate cannot be reduced to enthusiasm or fear. In the end, the stablecoin revolution is not really a story about coins. There may be no physical coin anywhere in the system. It is a story about the gradual transformation of money from object to record, from record to electronic balance, and from electronic balance to programmable token. Each stage makes money easier to move while placing new demands on the institutions responsible for trust. The first metal coin could pass from hand to hand without asking permission from a bank. The first banknote made large values easier to carry. Telegraphs allowed financial instructions to outrun physical transport. Computers turned ledgers into databases. The internet connected those databases globally. Blockchains now ask whether the unit of value itself can travel through shared networks as easily as information. That question is larger than cryptocurrency, and its answer will not be determined by engineers alone. Bankers, lawmakers, central banks, businesses, investors, and ordinary users will decide which forms of digital money earn enough trust to survive. The outcome may be messy. Different countries may choose different rules. Some issuers will fail. Some technologies will disappear. Banks will adapt. Governments will intervene. New crises will expose weaknesses no one anticipated. But that is how monetary systems have always evolved. They are not designed once and completed. They are rebuilt after every innovation and every failure. Stablecoins are simply the latest force pushing that reconstruction forward. For generations, digital money moved primarily through networks controlled by banks and payment institutions. Stablecoins introduced another possibility. Dollar-denominated value represented as tokens that can circulate across programmable networks operating continuously around the world. They may never replace the banking system because much of their strength still comes from the very system they appear to challenge. But they could change the routes through which money travels, the institutions that profit from those routes, the countries whose currencies gain influence, and the expectations people have about how quickly value should move. If that happens, the stablecoin revolution will not be remembered because a new kind of cryptocurrency became popular. It will be remembered because an old idea, the dollar, learned to travel through a new kind of network. And the final question will not be whether digital dollars can change money and banking forever. The deeper question will be how much of the old financial world must remain underneath them for the new one to work.